We thought it would be useful to have a panel of people who work in the financial markets. Actually, all four of these people have, at some time in the past, worked at the Fed, I think, right? Haven't you all? Yeah. To talk a little bit about what's it like to sell out to the private sector.
It's great, David.
But Julia said maybe this should be called the panel of the whiners. But Alan specifically exempted the people who were good enough to come and participate. So I'm joined by Peter Hooper, who's at Deutsche Bank Securities, Vince Reinhardt, who's at Standish Mellon, Julia Coronado, who's at Graham Capital Management, and Roberto Perli from Cornerstone Macron. We at Brookings are trying to be very transparent, so I've been asked to note that Graham Capital, Cornerstone Macro, and Deutsche Bank, the parent, all have made contributions to Brookings, which helps make the work we do possible. They're not funders of the Hutchins Center, and on this panel and every other, we maintain our commitment to independence and underscore that they're all these people are speaking for themselves and not for their people who give us money and vice versa. So
that means I'm not going to be invited back.
No. No, but contributions will be accepted. So I wanted to start with one sort of fundamental question, which is, it has been asserted that communications from the Fed have many purposes, but the only one that people in the markets want is to know what's going to happen in December, what's going to happen in February, what's going to happen in April, and so forth. So is that right? Was that basically your job, to figure out what's going to happen to rates or not?
No.
Okay.
No, so I very much disagree with this characterization of what market participants want. So market participants live in a world that is inherently uncertain. So it would be nice if we knew what the Fed's going to do next year. Heck, it would be nice if I knew what the S&P is going to be tomorrow. I can retire, right? But unfortunately, that doesn't happen. So what market participants want is clarity. It's not certainty. It's different, right? So sometimes, so there's been a lot of talk here about transparency, and I think that's very important for many of the reasons that John pointed out. But sometimes transparency and clarity are the same thing, and sometimes are not, right? So maybe one dimension along which the Fed could try to improve its communication is along the dimension of clarity, right? Not so much transparency for the sake of transparency, or maybe for other reasons that the market participants don't necessarily care about. Clarity is very important.
Okay, I'm going to get you to explain what you mean by that, but let me ask the others. So do you agree with Roberto that you're not paid to tell me what the Fed's going to do in December?
I'll take the other side. I think, I mean, the reason people want to hear from the chair is they want to hear from where the decision's going to be made, the perception. The reason that your survey come up with these B and C grades is people perceive that the Fed has been misleading, it's been wrong in its predictions, this has not been helpful, and I think that's just an indication of the ultimate importance of that issue. Where are rates going, and how do we sift through all this information that's coming out to try to divine that? That's the perception I get from people I talk to in the market.
Do you agree with that?
Partway, yeah.
There's a difference between being wrong and being misleading.
Now, the reason, I understand the reason for these low grades, and that's an indictment of the entire profession. I mean, economics has not gotten it right for the last 5 years. That's not, the Fed doesn't get inordinate blame for that. There's some problems around communication, I think, that have maybe clouded things, and the perception that they're not able to or willing to come up with a reaction function that would help people work through things. But we've talked a lot about the reasons for that. I, as an economist and a former Fed economist, certainly understand that. I have some difficulty sometimes convincing people in the market.
So sticking for a moment to the purpose, is it unfair, the characterization that basically what the people you work for want to know is what's the Fed going to do and everything else is detail?
No, well, it's not that simple. Yes, of course they need to know or want to know what the Fed is going to do, and part of my job is to help divine that, and that's not a nefarious purpose, by the way. The Fed conducts its policies through financial market conditions, and so whatever they want to achieve in terms of rates and accommodation or tightness, they achieve through the portfolio managers I work with. So it's the way it works. It's not a bad thing. There are a lot of different market participants. Am I a market participant? I'm an economist. I don't actually have to make a bet and put money down. That's what the people I work for have to do. They, by the way, have, they may not be who you're surveying, and they have actually priced in a path of Fed policy that's been more consistent with actual Fed policy for some time. So it may be that the media or the Fed watchers aren't as perceptive about all the uncertainties and the other things that are affecting Fed policy as the people who are actually putting money to work, who have understood that rates would be lower for longer for a while.
So Vince, you've been involved in helping the Fed communicate. You've been involved in commenting at it at AEI, and now and also with the markets. Do you well, first, is it just basically what the markets want? Just tell us what's going to happen, and the rest is detail, or is there something more to it than that? Julia makes the point. There's nothing wrong with that. Right. And secondly, how do you think they're doing?
So if a view on the Fed is supposed to get into market prices, it gets through market participants' actions. So I think Julia's right there. And I think the short answer depends on where I'm standing. If I'm in the middle of the trading room floor, I'm the most important person there at 1:59 on a Wednesday afternoon, but I'll also be the most important person there at 8:29 this Friday. That focus is narrowly directed toward the information that moves markets. That's the trader's perspective. When I'm taking part in the portfolio strategy meeting, because I've been on the policy side, on the sell side, buy side, and the think tank, a part of portfolio strategy, whether the Fed acts in September, November, or December is not particularly relevant to the discussion. We spend a lot of time doing scenario analysis. If this happens, then this happens. If this happens, then here's where we'll be in 6 months. Where we'll be in a year. And it's those market participants who need to understand how the Fed acts. It's the set of policy intentions and how they interpret the economy, because how the Fed's actions reveals something about their view on the economy, and that may be an informed view.
Okay, so I want to go to what is it that you think, what is it you want that you're not getting, and how could the Fed do it differently? Roberta, you distinguish between clarity and certainty, which I kind of get in the dictionary sense, but what exactly could the Fed do to be clearer, given that there's a lot of uncertainty?
Famous reaction function, right? So
Alan told us it's a metaphor. So you want an equation or what?
No. So we learned, I think, in the recent past, that putting down numbers perhaps is not the best thing to do, because of course reality can change, right? But look, simple example that I think Alan brought up earlier. What does it mean when the Fed tells us? We waited because we want some more confidence, what was the exact word, some more evidence, some further evidence that things are going the way we want to. What is this further evidence? So how are we supposed to figure out what exactly that is meant by that? So maybe, I don't know that Alan's statement is exactly the best possible way to get around the system, because I didn't have the time to study it. I saw it for 3 seconds, but sounds like a good way to do it. Chairman Bernanke, you said, well, Alan put together the statement because he knows already, right? But the difference is that he had to wait 3 weeks to figure out what to write in that statement. So if you put it in the statement the day of the meeting, you just wait half an hour after the meeting.
Right? But there's a problem. If there was, as I said earlier, if there was one Federal Reserve governor who made all the decisions, it would be relatively easy for him or her to say, look, these are the 3 things I considered, 2 pointed one way, 1 pointed another way. But we have 19 people, like it or not. Aren't you asking an awful lot for them? It's hard enough for them to agree on what to do. Now you want them to agree and explain to you how they came to that decision when they probably all got there from different directions.
But I don't think it's particularly complicated. During the meeting, there is a discussion. So I say something, and I'm in favor of doing a certain thing. You are in favor of doing something else for a different reason. How hard is it to synthesize those different positions in 3 lines? Like
And the dimensions
Alan
of the
did?
debate are sort of long-standing. It's not like that just came up.
So what would you do different? What do you find them frustrating, misleading? When I told you we were having this conference, you couldn't wait to get up here and tell everybody what the Fed was doing wrong. So here's your opportunity.
Well, no, okay, so look, to be fair, I will say
Don't be fair. That's not why you're
Well,
here.
I like to be fair. The overarching problem is that the reaction function has been changing. The world has been an astonishing place for many years. Now we're calling it R star, being low, but that just means we've had rates at 0 for a long time, and the economy isn't booming, and inflation isn't high, and it hasn't met our mandate. So we'll call that low R star. But
R star being the equilibrium interest rate when things are normal. Yeah.
But you know, the biggest hurdle has been that the reaction function is changing because the world is changing because we live in extraordinary times. It's hard to communicate. And then you sort of hem yourself in with this SEP, which projects, and I get all the caveats around what it is and isn't, but it projects this sort of linear structural framework that pretends to understand that if X happens, then Y will happen and we'll do Z. X being growth, Y being inflation, and Z being Fed rates. But actually, there's a whole lot of other things happening that complicate those relationships and lead to a different outcome, even if X and Y happen as we expect.
So if the Fed killed the dots tomorrow, would you applaud?
Yeah, I think, you know, they aren't explicit forward guidance, but they sort of presume a sort of direction and speed of travel and convey a level of certainty and the key variables driving things that may or may not be true.
Does everybody agree that the dots should be killed, or do some people want to defend them?
I'm definitely not in the ditch the dots camp. I think they serve a purpose. The cat is out of the bag. It would be awfully difficult to put it back in at this point, and I think you can improve upon them a bit. I would be in favor of not naming, but labeling or giving a color code so you see some consistency across SEPs and dots, and maybe you can get a little better idea what reaction functions are through some further analysis. So there's maybe room to improve there, but no, I think they should stay.
You on the dots? Keep them or change them, or?
I would, like Peter, I would improve them. I don't think it'd be productive to get rid of them altogether. I think there is some useful information can be made better by connecting them, perhaps.
What do you think, Vince?
I'd keep the dots, but change the format. The thing to remember is the committee backed into relying on the summary of economic projections because they couldn't agree on a forecast as a group, and at least could agree to send in an Excel worksheet, you know, at the time, twice a year, and now 4 times a year.
Before the meeting.
Before the meeting, with the ability to revise after the meeting.
Which rarely happens.
Which rarely happens. So it is a second best to the second best. I think talking about Federal Reserve communication the way we are is shooting the messenger. The problem is not how the committee communicates, it's how the committee decides. The committee isn't as much a group as it could be. The meetings themselves are relatively inefficient, and the statement has become this mechanism to buy off competing FOMC participants, and has grown to the point where it's unwieldy and unhelpful. And because they don't find a common ground, because they basically each go as individual voters, raising the question that Ben asked, why bother even traveling if you've already made up your mind before the meeting? There's no joint individual ownership of the decision. And therefore, it's hard to communicate.
Before you came in, Alan Blinder was making the point that in his view, the way the law works, it's the FOMC as a group that should be accountable, and part of the problem is that we have this tension between individual and group accountability. But let's assume your diagnosis is right. Okay, what do we do about that?
By the way, John had the exact number in his paper that signaled that view, and that was the number 12.
Right.
The Congress of the United States formed a committee in which 12 people make a decision. That means they wanted them to act as a group. It was an explicit rejection of the median voter theory, right. Whereas I think now individual FOMC participants are much more, atomistic
So
actors.
this is just a personality thing. If we had a different set of people, it would be better, or are you proposing a structure?
I think it's more about process, i.e., and the same people could do it. It's just a question of what's expected at a meeting, i.e., what do you talk about? What do you conclude? How do you use the statement? I think if you're asking my list of how I make changes, I would link the forecast as the combinations. Why separate them? I don't think I do the important person, unimportant person, but I just give the 19 combinations. I would make the statement shorter and rewritten every time, and I would make the committee own more of the statement. And I think,
How do you do that?
you don't let them leave the room until there's more of a. I'd make the FOMC process terrible.
Don't oversell it, Vince.
Yeah. And I think there would have to be more management before those meetings too. And you do the press conferences 8 times a year. I think the chair's opening remarks at the press conference is the common hymnal that Alan Blinder wanted when he was vice chair. Those things the committee could agree as a group. I think now there's a certain, I almost call it laziness, of not coming to hard decisions as a group and saying, well, the chair can take care of it in the press conference. Well, if it was important enough for you to want the chair to talk about, then you should own it as a group.
But a shorter statement.
Yeah.
Sounds like a challenge. I was thinking earlier, we at the Hutchins Center built a video game or computer game called The Fiscal Ship about fiscal policy. And as we were talking about level 12 on the video game of the Fed, I began to have fantasies of our doing a thing where you get exogenous shocks like leaks to the Wall Street Journal or something. And I think there's potential here. A couple questions. One is, so a lot of the problems that the Fed has are not unique to the Federal Reserve. How do you compare both the form and the quality of their communications to Bank of England, European Central Bank, Bank of Japan, and so forth? Better, worse?
I would say one thing I have noticed in making that comparison is that I would say Bank of England and the ECB, definitely not the BOJ, but those two institutions, they just tend to be plainer spoken. A lot of Fedspeak kind of has to be all embedded in this sort of, they want to say it without saying it, kind of a little bit to Alan's point of rewriting the statement. There were some people that wanted this, there were some people that wanted that. This is what the majority feels like we need to do right now. This is where we came out. Just kind of say it in plain language. And I think, there are people, I would actually say Governor Powell and Governor Brainerd have been in the camp of being plainer spoken. I'm worried about this, and so I think this. And I think the other banks are more just kind of saying
What do you think about the Fed versus its peers?
So one thing I think we're moving towards is a press conference every time, a la ECB. BOJ is reforming things as well in that direction. I think that's probably going to become the norm. The Fed has to deal with the cloud, the cacophony of many more speakers. And I certainly agree with the notion that it would be desirable to enforce the notion that if you're going to speak, give the house view first. I mean, I wrestle with this at Deutsche Bank. We have a house view on the economy. We have many bright people who have alternative views. When they go out and speak to clients, they give the house view, and then they say, okay, here are the risks around that. Here's what I think. But I think you can
Maybe a little easier to enforce at Deutsche Bank than at the Federal Reserve System.
Might be, but I think a little more emphasis in that direction would certainly help. I certainly don't think we want to muzzle the bank presidents. I think as was noted, they have a number of roles, and one is to outreach, to inform, et cetera. We get a lot of feedback from. I kind of did an informal poll of my clients globally in travels in recent months, and the fact that a bank president came to Australia or to Latin America, that's, in whatever their view, the fact that they're out there speaking and giving some, that's really appreciated. The Fed is extremely important globally. So I think there's an important function there.
So I'm a little bit puzzled. So when you generally talk to people in the markets, everybody seems to have a lot of complaints about what the Fed does in communications. But so far what I'm hearing is Vince wants to change the way the FOMC comes to decisions. That's a pretty fundamental change. You all seem to like the idea of either improving the dots or getting rid of them. That is, linking the interest rate forecast to individuals' inflation and GDP forecast so you can see something. It sounds like tweaking. Is there something bigger that you think the Fed could do that would improve the quality of communications with an eye towards the policy effectiveness goal that John outlined? No, Roberto.
No, go ahead. No, well, so one thing that came out from your survey, right, was brought up earlier as well. The chair should speak more. Good, fine. I think everybody would agree with that. It's not enough, though, right, from the point of view of market participants. So if the chair simply reiterates the message that was communicated at the previous FOMC meeting, there's not a lot of value, right? The chair can give 35 speeches per year and doesn't make a lot of difference. I think what would improve the clarity of the process is if the chair, and only the chair, right, because it is the chair, would go out there and say, hey, we received some information between now and the previous FOMC meeting. Here is how at least I think about it. Maybe the chair cannot speak every single day for the whole committee, but here is how I think about it. So provide some guidance. So you don't have to tell the market this is exactly what we're going to do, but providing a way in which the market would interpret the way the Fed is going to think about this.
Why would that? I mean, we could adopt the Donald Trump approach, which would be to have the Fed chair tweet commentary on every economic indicator. Someone imagine the tweet, markets down, sad. But so what purpose would be served by getting the chair to every 2 weeks say, well, you know, information's come in, it's a bit mixed, a little bit more on the inflation upside?
No. So I think, look, we are comparing a little bit. The comparison is not particularly pertinent.
I agree.
So
it was a good line, though.
I think, yeah, it was. I mean, look, anything that has to do with that subject is a good line these days, right? But look, monetary policy works through financial markets. Right. So if financial markets don't understand what the Fed is up to, monetary policy doesn't work. And so it should be in the best interest of the Fed to communicate as clearly as possible. Don't commit to anything, but communicate as clearly as possible how you're thinking.
I'm going to take a little bit the other side. I don't think there is a huge issue. You might hear a lot of whining, and I think that we've all sort of agreed that's a kind of an inherent part. We whine, you know. It's not. It's just people are used to seeing the Fed as the cause of things. But as Vince said, you know, when we're thinking about bigger strategic decisions, the Fed is reacting to economic conditions, right? And we're all thinking about the bigger picture, which is what really matters. And I think so when it comes to Fed communication, it is mainly just tweaking or structuring or improving rather than complete overhaul that's necessary. We've talked about things like a set of best practices. You know, I don't actually think the Fed needs to speak more if it was just more balanced, if the Reserve Bank president spoke less. What is the right forum to speak at? Going on CNBC after the employment report, maybe not so helpful. But, you know, defending the core consensus view and how it was arrived at the beginning of each speech, probably helpful. You know, setting some guidelines. I know the Fed wouldn't do that because it would take them like 5 years to do it, but maybe you could do that at the Hutchins Center and, you know, come up with a sensible set of best practices for Fed communication. You know, maybe that would kind of put a little pressure on some of the speakers that like to speak overly much or in many, many different forums, or get others to speak more.
So I think from my perspective, the Fed disappointing me is just a win-win situation because it's an opportunity for me to be sarcastic. I get out of my shell.
We all have to do it. We're good.
I think, again, going back to the issue, it's about deciding as much as communicating. I think they got to work harder on coming up with a central view of the economy, more ownership of the Fed chair's opening statement in those 8 times a year press conferences go pretty much as far along as you're gonna want. I think that absent that, the unfortunate direction will ultimately they're just going to have to release the staff forecast.
You said earlier that you thought that they ought to write a new statement every meeting, as opposed to keeping it and then changing one word and having the Fed funds futures move 15 basis points on that adverb. Why do you think they ought to rewrite it every meeting? And given that you were in those meetings, is that practical?
So I think it would be, first of all, the statement is too long and filled with tautologies that are stated once, then first difference, then still remain a tautology. So I think taking that out would be helpful in itself. And that the economy, it's true the economic outlook doesn't change all that much for 6 to 8 weeks, and you have to report on the labor market, you have to report on inflation, you have to report on your outlook going forward. So it will look similar, but starting from a fresh piece of paper a week and a half before is better than starting with what you had 6 weeks earlier and just encrusting it with more detail.
I wouldn't shorten it. Maybe you can make it more efficient, more effective. Alan Bliner had a great idea, I think. And if you give the whole committee a hook in a statement that explains, you know, the different views, the majority and minority view, give somebody out there who's talking to his people in his district a basis for, here's our central view, here's why I thought this. I mean, I think it would really help to give
so I
the
think
framework.
the problem with the statement is it is not as much written for us as written for each other. And that over time, people add things to it so they feel better about their worldview. In the same way the minutes just has everybody's view, and you lose the sense of the central tendency, as John's paper points out. And it's in that sense, I think the statement is too complicated, because it actually is just pitching this enormous tent that allows 19 people cover.
Right. Well, as John pointed out, part of the communications is a way to get the consensus, and so there's a tension between having a deliberate.
But if you're using statements in between meetings to signal your policy intention for the next meeting, it means that meeting isn't very efficient.
Right. Let me ask one final round of questions, then we'll go. So there's legislation pending, which actually passed the House, and as I understand the argument that the Republicans in the House have made is the Fed isn't really accountable because we don't understand how they make decisions. That somehow the Washington Post and the Wall Street Journal seem to have some sense of what the Fed is doing. So that must be because they get information from the Fed, which there's some truth to that, as the public records of the Fed chairman's schedule show. They have some allegations that stuff is leaked to the market people. This is the argument. And that the people who are left out of this conversation, who really don't understand what the Fed is doing, are the elected members of Congress. And the solution in the Hensarling bill is to force the Fed to enunciate a rule. The legislation uses the Taylor rule, although I think there's some wiggle room. They could do another one. And then the Fed should have to explain, this is why we're doing what we're doing. And if we're deviating from the rule, we have to explain why we're not going along with the rule. Would that make things better or worse?
Let me, two small steps in that direction. One, I think one of the conclusions from the research for this session is the Fed needs to do a better job of explaining its reaction function. It needs to, you know, well, let's work harder to get some sort of consensus here on some of these key parameters. That's moving in this direction of a policy rule. We all think, Fed folks think policy rule is a bad idea, put the Fed in a straitjacket, but maybe the distance between these two is not all that great. And certainly there's agreement that the chair could spend a little bit more time explaining things. If doing 8 press conferences a year would be a lot of work. Maybe we could do something short of that, have a session with a rotating group of subset of press folks periodically intermeeting to explain things, make sure the press is on the right
I think the solution is
path,
going to be they're going to trade. For every press conference is one less congressional testimony. I think any Fed chair would buy that in a heartbeat.
That's 4-3 right now. But,
But that was the spirit of Humphrey Hawkins, right? I mean, there's nothing wrong inherently with the Fed communicating well with Congress, and you can put whatever structure you want around it.
Right, but I think that what the Hensarling bill says is this kind of periodic reporting where we get this vague sense is not sufficient. Maybe they long for the days when they had the monetary aggregates, which goes back to the early days. I'm looking for your opinion on whether legislation like this would be a net positive or a net negative to the functioning.
I don't think it would change much. It would just add another venue or layer of communication.
What do you think?
I agree. I mean, I think most of the times, presumably the Fed would end up not abiding by the rule. They would explain why they didn't follow that rule, and the market
Which is what they do right now with the SEP.
Right.
Yeah, so lawyers trying to describe an equation in a legislative draft is quite a work of art.
It's worth reading.
It really is.
Yeah.
If you haven't done it yet, you should. I think the FOMC meetings are inefficient. Even worse is congressional oversight of the Federal Reserve, i.e. the semi-annual testimony and the hearings are just a terrible waste of time because it's very rare that there's a useful question on monetary policy. My own proposal is twice a year, the GAO should do an audit of Federal Reserve monetary policy, an even-handed description of what rules would say, what standard rules would say, talk to a bunch of economists, have a range of views, and list 30 questions in the back that would be useful to ask the chairperson of the Federal Reserve at the next hearings. Because there's a fundamental imbalance, they're just not, our representatives are not prepared to ask questions about monetary policy.
So you're not content with just fixing the FOMC. Now you're going to move to fixing Congress.
Yeah.
Just to clarify. So I think the concern about, quote, audit the Fed is that the GAO would swoop in and basically do cross-examine every policymaker. Is that what you have in mind? Or?
No. So I think that it has a legislative fix. You let the GAO only do 2 audits based on outside information, and most GAO audits are just even-handed exercises, as dry as toast to read.
I threatened to call on people here who work for the Board of Governors to see, but I was advised that would not work. There was one question there, gentleman there. Yeah, go ahead, Peter. Remind us who you are.
Yeah, Hans Roger VB, La Financière Jacob Webson. The Fed, the ECB, the Bank of England are supposedly academic institutions in which we seek scientific proof. Bob Lucas and a few of my former instructors used to remind us of what economic theory is, which is approximation. Yet members or former members of the board or those who have worked for the Federal Reserve Bank are asking for certainty. I suppose, which certainty are you referring to? And I pose a question going back to the statement of the FOMC on May 1st, 2013, and the statement of then chair presented before the Joint Committee before testifying and responding to the Q&A. It seemed to me there was zero deviation from what the committee had said before in justifying either policy normalization or staying pat. Yet we had a 600 deviation move across major asset classes. So I suppose the simple question is, what else do you really need the Fed to do? It seems to me the Fed is communicating much more than it needs to be.
Okay, so I'm not sure that I agree that the Fed, the central banks, are academic institutions. I think I think they're technocratic and that they're supposed to be experts, but we live in democracies and they're accountable to the public. The Federal Reserve is created by Congress. It is accountable to Congress, and I think even people who believe very strongly in Fed independence believe that it was in the purview of the Congress. If the Congress wanted to set a different mandate for the Fed, that would be legitimate. It's not. We don't live in a situation where we have to go to some where this is written either by God or by the National Bureau of Economic Research. But the questioner asks a good question about, there's a lot of talk about the taper tantrum, and I think that some of the indictment is that wasn't some people say it's a failure of the Fed, and some people say it's a failure of the listeners to understand. Just what's your perspective on that?
So I was just going to say that, going back to the Fed's had a bad record over the last 5 years. We've been focusing on the negatives, what to do about it. Economics professions had just as bad a record.
Record in forecast.
In forecasting, in anticipating, in giving guidance about where policy, and I think the problem with time-based guidance is that you're more likely to slip up in in a way that's very clearly identifiable. And I certainly think that now that we're off the effective lower bound, it's time to de-emphasize that. But I think over the last year, and certainly over the last 6 months, Fed's been getting higher marks for, few surprises, and everybody's right on spot on for December here. So
that goes to my earlier point that defines success is that if the Fed funds futures gets a 99% that rates are going to move, the Fed has communicated well. That strikes me as not necessarily the only standard that one could use for judging Fed communications.
Well, it's helpful also that the economy and data are moving in the right direction to support that. But
it is a reflection that the markets are correctly reading the reaction function of the Fed's communicating it well. And I think the taper tantrum definitely wasn't a failure of Fed communication. The Fed had been talking about tapering for months and months and months. It was more, I think, it was a surprising revelation of the reaction function. There was a real, my interpretation, there was a real desire inside the board to just get out of this policy for reasons other than just the functioning of the economy or inflation progress, and that came through and was a surprise to markets. It was real information about the reaction function. It wasn't that they weren't telling us all along that this was on the table. It was like, well, the fact that you would do it with core inflation going down was a surprise.
John, I'm going to call on you. Otherwise, I'll have to make up more questions. What advice would you give people in the markets, like the 4 people sitting up here, so that
he
they
gives
don't?
us advice all the time on his blog.
Well, let's say we can do it in real time here.
So to the extent that the FOMC doesn't change anything, I do what I think everybody said: listen first and foremost to the chair when you want to know signs about where the consensus is likely to go. Not because the chair runs roughshod over anyone or the chair's the only one who has ideas about that, but the communications policy says nobody else can say anything. That's the policy. The chair has the obligation to do that, and so listen to the chair about that stuff. As everyone has said, the presidents and the other governors, they say lots of useful stuff. Listen if you like, but it's not about the future of policy.
So why do the markets move so much on a speech by a Fed president?
But it's not so. It's not very clear that they do in the first place. They do in some occasions, and that's why I think these poor bank presidents are much maligned, as someone said earlier, and they shouldn't be, because many times there is actually signal in what they're saying. Take, for example, when someone that has always said the same things forever and ever and says again the same thing, well, fine, right. I don't care. But when someone who has said the same thing over and over and now all of a sudden said something different,
right.
Well, that's a signal.
There's information.
If that someone is perceived to be on one end or the other of the committee,
Eric Rosenbrand coming to
Eric Rosenbrand shifting, that's an important signal.
Do you think that there would be politically acceptable ways for the Fed to communicate better with the people who are in the business of watching the Fed from the private sector, or as Ben Bernanke suggests, is just kind of an impossible thing, that if they're seen as meeting with you, that's just going to get a lot of bad publicity for both?
Oh, you mean communicating directly and getting feedback? I mean, there's forums you can do for that. Each regional Fed has advisory boards, and there are, you could create more opportunities for communication where it's more public, or, you could, I do think it's important that there is a give and take in a flow, because we come at it from very different perspectives, and both have a lot of value and legitimacy. It's not like one is right and one is wrong, but it's sort of like, Fed is from Mars, markets are from Venus, we need to talk and communicate. So I think creating the forums in a world where, there's heightened sensitivities about, the appropriateness, just create the venues for doing that. This is such a venue. I mean, there's other venues you could create where there's an opportunity for an exchange of views.
Do you think that the press plays a constructive or an unconstructive role in communicating what the Fed does?
I don't think countdown clocks are particularly helpful, right? And that is part of the creating of the event. It is why sometimes bank presidents' speeches get more attention than perhaps they deserve. They are the event of the day. There's something to respond to, something, your opportunity to square a position here or there. I think, the fact is, what's the regularity? Fed never surprises market participants in action. Sometimes they disappoint by not acting when it's priced in, but there hasn't been a market surprise. I think you can ask the question, might it be appropriate on occasion for the Federal Reserve to act when the probability of that action is under 75%? We're really seeing that now in where you have the slowest renormalization in Federal Reserve history. If you're only going to act once or twice a year, it means the unconditional probability of acting at one particular meeting is either 12.5% or 25%. You actively have to talk it into markets to get it priced in. And then how are you getting an independent view on markets?
Right.
So the fact that the probability of policy action at the December meeting is 100% is not evidence that everyone understands the Federal Reserve policy rule. It's evidence that they've just kept telling us over and over again they're going to act in 2016, and they're running out of room.
For a paper entitled Language After Liftoff that my USMPF colleagues and I put together early this year, we took a look at several instances of press reporting around key turning points for the Fed. Generally, the statement coming out of the Fed would be something like, if so-and-so, very conditional, we will do such and such by this date. And invariably, the headline is the Fed will be doing such and such by this date. It comes out, and often without the qualification. So I think one lesson we drew here that the press could do a better job of explaining the qualification,
I
but
think
that doesn't make headlines.
Conditional statements seem to be hard for the press, the public, sometimes the markets, and definitely the Congress to understand.
And I think more the media than the markets. Again, the markets have gotten it better. The media always focuses on that, are they going to hike next time or not? And the headline generating rather than the nuances and the issues and what's the debate.
So, Roberto, did you have a question now? Oh, please.
I want to suggest that you have the right people up here on the stage now to discuss the wrong question. So
I think that's a compliment, but I'll choose to take it that way.
It was both. The title is What Does Wall Street Want? Fed communications are aimed at multiple audiences, one of which is the financial markets, another of which is the Congress that you just mentioned, because the Fed is legally accountable to Congress. And then there's the broader public, the tiny minority of the broader public that pays any attention to the Fed. They are only going to be informed via the media. Mm-hmm. And that's the media's role. And what I really want to suggest is, point one, often those three audiences can be helped in the same way. That was the spirit of that mock statement that I put up. But where there is conflict, the Fed should not even care about what Wall Street wants, because the other two constituencies are just vastly, vastly more important to serve.
Disagree, obviously. How dare you?
When Krishna asks it, it always starts with, wouldn't you say?
I mean, financial conditions are one of the key variables that translates policy to the real economy. For the person who's not reading the New York Times story on what the Fed said or did the prior day, they will see what interest rates are doing and whether that makes a house more or less affordable. So, I mean, as distasteful as we all are, we are an essential conduit, and that's never going to change.
Perhaps the issue is not, I agree the Fed shouldn't do what the markets want, but the markets are important, so the Fed should explain what the Fed wants to do to the market so the market understand, and therefore the two are in sync, right?
Right, but I think Vince referred to something, I mean, Jeremy Stein has written about this, that the Fed has gotten itself, if I can remember Jeremy's argument correctly, the former Fed governor, now back at Harvard, that the Fed has gotten itself in a bad position because it worries so much about how the bond market will react that it does things that are counterproductive. And he made the point that surprising the bond market once in a while would be a good thing. That would not be consistent with your clarity point.
No.
And I think a lot of
So-
folks don't agree with Jeremy on that. I think Dan probably doesn't agree with Jeremy.
No.
Just to throw that out.
Alan, you've made a couple extreme statements here. 98% on Janet versus everyone else. I would have put it closer to 51%. Because I think Janet's job is to build a consensus and getting a sense of how the whole committee is going. I think that there's some importance there. But to say no, almost no impact, no intention to the markets. I mean, these are all equal constituents.
So
I
the
think.
other two are vastly more important, which is
Where they conflict, yeah.
Right.
they don't. My argument would be they don't conflict.
So a couple points. One is, I think the quandary there for John is, if you're only going to tighten once or twice a year, and you're only willing to tighten if it's 85% priced in the day before, then it means you're going to have to actively put it into markets, i.e. you are going to split with.
They've always done that.
That's the question. Is that the right way to do it?
What would you learn on the day before the meeting that would change something? I mean, it's an accumulation of economic developments that leads you to a decision. So you react and you build the expectation. What would you learn the day before that would make you suddenly want to shock the markets? I don't understand that.
No, that's something that is priced in as 50%. Half the time will happen. I don't see that as a shock to market participants. And I think to Alan's point is when you were working on a speech or a testimony, and here that the redesign of the Wall Street Journal renders even more of my human capital obsolete. You'd say, is this going to appear on A1 or C1? You know, sometimes you're taught, or is it even going to wind up in USA Today?
How many tweets is it going to
Right,
get?
and I think you have to respect that there are different audiences that you talk to at different levels, but it has to, if it's an inconsistent message across, you've made a mistake.
No, I think what Alan's saying is, well, yeah, Larry.
Thank you very much. Larry Checco, Accountability Central. We've talked a lot about uncertainty today, and like everything else, there are degrees of uncertainty. And I'm just wondering how this panel feels about this new administration and whether uncertainty will spike, stay the same, and what advice can you give investors?
Ooh, I'm not going to.
Well, I'll take the first cut at that to see before anybody decides if they want it in there. As I said to someone earlier this morning, that people like me in Washington who either talk or on the radio or write for the Wall Street Journal or write on Brookings' website and predict things always say that, well, it seems likely, but you never know that the Congress will pass this bill or the Fed will raise rates in December. But that caveat is usually complete crap. It's just something that people say to cover themselves in case they're wrong. In the case of the Trump administration, when people say, I really don't know what they're going to do, they mean, I really don't know what they're going to do. So I think it seems to me it's obvious that there is much more uncertainty today about what the economic policies of the new administration, the new Congress will be, than we usually have at this time in the cycle. I would think that can't make the Fed's job any easier, but the reason we have an independent central bank is so that they can adjust if fiscal policy moves in unexpected ways.
The Baker-Blumen-Davis index, for what it's worth, has jumped.
This is the University of Chicago index that reads a lot of newspaper articles.
Economic policy uncertainty index, if you will. That's shown a pretty big jump, as could be expected. But this is obviously a case where the Fed, giving as much information it can about its reaction function, is going to be critically important to the market. Okay.
But I mean, I think because that uncertainty is very high, and this is all going to unfold actually relatively slowly. I mean, the economy is sort of an ocean liner, so it's not like whatever happens or doesn't, it's going to have to be legislated and discussed and debated and then implemented, and then the economy will react. So the Fed has plenty of time, I would say, to step back and say, we're going to see how this evolves, and, you know, for now, the plan is the plan, and, you know, if circumstances change, then the plan will change, but you know, they don't need to decide tomorrow or communicate at the next meeting exactly how things are going to look in 2017, different from how they did before.
No, but I'm glad I don't work at the Fed and have to make a guess on what fiscal policy is going to be for the next 2 years.
Right, but you know, I would completely agree. There is a lot of uncertainty, right? But among this uncertainty, there is the possibility that what the Fed has been asking for years and years, which is a supportive fiscal policy, actually happens, which is what the market is pricing in these days, right? So we'll see. There's probably
And if it
reasons to be
materializes,
skeptical.
then
Right.
they may have to raise
Okay,
rates more.
I want to thank all of you for coming here and doing this. I think it's actually been pretty interesting. Why don't you just stay up here for a minute, and I'll introduce Jay Powell, and then we'll switch. Jay Powell, of course, is a governor of the Federal Reserve, and we wanted to give some sitting policymakers at the Fed a chance to talk and respond to this, and Jay very graciously agreed to do that. Jay has been a governor since 2012. Given the fact that he's now serving a term for that extends to 2028, I think we can expect him to give us the real long-range view of monetary policy. Jay is not an economist. He's a lawyer and worked at the Treasury and in the private sector before going to the Federal Reserve Board. And I really want to thank him for agreeing to step into this situation. So please join me in thanking the panel and welcoming Jay Powell.